Dancing to its own beat, all the way to Wall Street, Spotify's IPO is the New York Stock Exchange's first ever direct floor listing. But ahead of its debut, the music streaming service was bracing for a rough ride. In a public letter, its CEO cautioned employees and fans of ups and downs, although others were confident of a strong start.
Oh, it's a high-risk decision to IPO at the best of times, and obviously tech firms are in the crosshairs at the moment. To be honest, we do think demand is going to be strong for Spotify. It's quite a sexy stock. It's quite a sexy industry.
Informal trading on Monday saw pricing for Spotify holding up, changing hands at about $132 a share. That would value the company at more than $23 billion. The listing allows existing investors to sell directly to the public while offering no shares of its own. It's a test case being closely watched by other multi-billion-dollar tech firms.
You allow yourself a little bit more control over where the shares are going, and obviously a lot of Spotify employees who may have been there since day one, their pay will have been in Spotify shares. They're finally allowed to make good on the promises and the investment they were given and allowed to cash out.
Although the move comes with its own risks too.
There's no bank behind it going, we're going to continue to buy out these shares to make sure we get some form of stability in this price until the market actually settles down.
Since launching a decade ago, Swedish Spotify has overcome heavy resistance from big record labels to transform how the industry makes money, offering access to vast libraries of music rather than making users pay for CDs or downloads of individual albums or tracks.